19 anonymous Fed officials set your next mortgage rate. More leverage over your bills than Congress and the Treasury combined. The new Fed chair, sworn in last week, wants to delete their chart entirely. Your June payment hinges on a tool that may not survive June. Let's walk the dominoes. The dot plot is the chart at the center of every Federal Reserve meeting. 4 times a year, 19 members of the Open Market Committee anonymously plot where they think the federal funds rate should sit through 2028. The chart drops at 2 p.m. Eastern on a Wednesday in March, June, September, and December. In the next 40 seconds, the bond market reprices every fixed mortgage, every auto loan, and every business credit line in America. Here's what almost nobody mentions on cable news. The dots are anonymous. 19 Fed officials each plot a single dot for each future year, and the chart is published without a single name attached. You don't know which dot is Powell's. You don't know which is the New York Fed president's. You don't know which dot belongs to the Kansas City Fed president's policy preference. That's by design. The mechanism was introduced in January 2012 under Bernanke, marketed as transparency. It rolled out alongside the third round of quantitative easing as the Fed's new forward guidance doctrine. The pitch was simple. Tell the market where rates are headed, and the market won't have to guess. Anchor expectations, reduce volatility, save everyone time. It did the opposite. Bond market volatility on Fed days went up after 2012, not down. Yellen took the chair in 2014 and ran the most disciplined dot plots in the program's history. Dispersion was tight. The median moved a quarter point at a time. The forward guidance worked because the dots agreed. By 2018, under Powell's first year, dispersion widened. By 2022, the Powell-era hiking cycle, the dots became a moving target the bond market tracked obsessively, even as Powell himself, on the record at the December 2022 press conference, called the dots not a great forecaster of future rate moves. So why does the bond market trade off them anyway? Because the dots aren't a forecast. They're a coordination signal. The bond market reads the median dot and prices that into every treasury yield, every mortgage rate, and every corporate borrowing cost. Once the price is set, the Fed is mechanically constrained to deliver the median or risk a market reaction. The dot plot doesn't predict rates. It sets them. The feedback loop is tighter than most retail investors realize. When the median dot moves a quarter point, the 2-year Treasury yield moves with it inside the first minute. The 30-year Treasury follows within 15 minutes. Mortgage-backed securities follow within an hour. Mortgage lenders refresh their rate sheets the next morning. Your mortgage broker quotes you a new rate by Thursday. The chain runs from a single anonymous dot on a chart published Wednesday afternoon to the rate quoted to a homebuyer in Phoenix on Thursday morning. 48 hours. No human discretion at any stop in the chain. The number is 40 seconds. That's how long the bond market took to reprice roughly $10 trillion of fixed-income securities the moment the March 2026 dot plot dropped. 2 trading desks at Goldman Sachs and JP Morgan reportedly cleared $80 million on the move by being faster than the rest of the market on the new median. And March's was the most divided dot plot in modern history. 7 members at no cuts for 2026. 7 members at 1 cut. 2 at 50 basis points. 2 at 75. 1 lone dot at a full 100 basis points of cuts. The median said 1 cut. The reality was that the Open Market Committee couldn't agree on anything. Markets traded the median anyway. Any retail saver with a high-yield savings account felt their rate get pre-cut, while the actual Fed funds rate hadn't moved a single point. Here's where it gets stranger. Of those 19 dots, only 12 people are allowed to vote on rate policy at the next meeting. The other 7 sit in the room, contribute to the projections, watch markets move trillions on their input, and then quietly leave when it's time to decide. The people whose dots count the most in market impact aren't always the people with the votes, which is the part that should bother you. The people drawing those dots aren't the people you vote for. They aren't even the people Congress confirmed. A slice of them was picked by a group most Americans don't know exists. And they were picked specifically because of their relationships with the banks the Fed is supposed to police. Actually, the Federal Reserve's voting structure is the part almost no one outside finance can explain. Here's how it really works. Of the 19 people who draw dots, only 12 get a vote on the federal funds rate. 7 of those 12 are the Federal Reserve Board of Governors. They're nominated by the President and confirmed by the Senate for 14-year terms. So far, so normal. The other 5 voting members are different. One of the 5 is permanent, the President of the New York Federal Reserve Bank. The reason is that all of the Fed's actual open market operations, every Treasury bond bought, every bond sold, every reverse repo settled, run through the New York Fed's trading desk on Liberty Street. The other 4 rotate among the 11 remaining regional Fed presidents on a one-year basis. Cleveland and Chicago share a slot. Boston and Philadelphia share another. The 7 who aren't currently voting still attend the meetings, still draw dots, still influence the median that markets trade on. They just don't get a hand in the legal vote. Now the question is, who picks the regional Fed presidents? This is where the structure gets sideways. Each of the 12 regional Federal Reserve banks has a board of directors. 9 people, split into 3 classes that the original 1913 Federal Reserve Act spelled out by letter. Class A directors are bankers. Class B directors are business and labor representatives. Class C directors represent the public. 6 of the 9, both Class A and Class B, are elected by the member banks in that region. Member banks are commercial banks, the ones the Fed is supposed to supervise. J.P. Morgan, Wells Fargo, Bank of America, Citi, and roughly 6,000 smaller commercial banks across the country. So commercial banks elect 6 of the 9 board members at every regional Fed. Those 6 then sit on the committee that selects the regional Fed president. That president then drops a dot 4 times a year and votes on the federal funds rate in roughly 1 out of every 3 meetings. Read that sentence twice. The banks the Federal Reserve regulates pick a chunk of the people who decide the Federal Reserve's policy. This is what I call the 19 versus 12 trick. The headline number is 19 people drawing dots. The voting number is 12, and the people choosing roughly a third of those 12 are the same private commercial banks the Fed is supposed to police. The structure was built this way in 1913, written into the original Federal Reserve Act and reaffirmed in the 1935 amendments that gave us the modern Open Market Committee. The idea was to insulate the Fed from politics. The result was to expose it to bankers. The Kansas City Fed's Board of Directors in 2026 includes the chief executive of a regional commercial bank, a former chairman of the Kansas Bankers Association, and the head of a community development credit union. They participated in selecting the Kansas City Fed president. That president draws a dot. In roughly 1 out of every 3 federal funds rate decisions, that president casts a binding vote on whether you pay more for your mortgage next year. The President of the United States can't fire him. The U.S. Senate didn't confirm him. The voters of Kansas, Oklahoma, Wyoming, Nebraska, Missouri, and Colorado never elected him. By now you're thinking, wait, that can't be right. Surely the Senate or the president has some lever to pull here. They don't. Each regional Fed president serves a 5-year term. He or she can only be removed by the regional Fed's board of directors. The president can't fire them. Congress can't fire them. The only people who can fire a regional Fed president are the same private bankers who hired the regional Fed board in the first place. This is why Kevin Warsh's promotion in May matters more than it looks. Trump had exactly one real lever on the Fed in 2026. Nominate the chair of the Board of Governors when Powell's chair term expired on May 15th. He used it. And the man he picked is not a hawk in the conventional sense. Which brings us to the actual story behind the new chair. Warsh's stated reason for taking the job has almost nothing to do with where rates go and everything to do with what the Fed tells you about where they're going. And what he wants to do to the chart you just learned about would change the cost of every mortgage signed in America for the next decade. Turns out, Warsh has been writing this plan for 15 years. He started his career as an investment banker at Morgan Stanley in the 1990s. He moved to the White House under George W. Bush, then got tapped for the Fed Board of Governors in 2006 at age 35, the youngest governor in Fed history. He served through the entire 2008 financial crisis. He resigned in 2011, citing frustration with the Bernanke Fed's communication strategy and its move toward open-ended forward guidance. He was inside the building when the dot plot was conceived in late 2011 and rolled out in January 2012. He's publicly attacked it from outside ever since. In an April 2026 Senate Banking Committee hearing, asked directly what he would change about the Fed's communication policy, Warsh said this: "The Fed tells the whole world what their dots are going to be, what their forecasts are going to be. Well, the Fed's human then. They hold on to those forecasts longer than they should." That's the public statement. The private plan, according to 2 of his former colleagues quoted in Fortune in April, is to abolish the summary of economic projections entirely. No more dot plot. No more long-run projection of where rates sit. No more median forecast for markets to trade on. Forward guidance. Gone. This is the opacity reset. Under the current regime, banks know roughly where the Fed will be 6 to 12 months out. Mortgage lenders price 30-year loans against that forward curve. Without the dot plot, the forward curve flattens to chaos. Banks don't know where the Fed will be in 6 months. They charge you for that uncertainty. Mortgage practitioners who priced loans in the Greenspan era will tell you the uncertainty premium ran roughly 30 to 50 basis points wider than it does today. Academic estimates of pre-2012 forward guidance show roughly the same range. On a $400,000 mortgage, 50 basis points is roughly $130 a month for 30 years. That's $47,000 over the life of the loan, per house. Spread across roughly 4 million U.S. home sales per year, the Greenspan uncertainty premium is a $60 billion annual transfer from American homebuyers to lenders. This is what Warsh wants to bring back, and the financial press is missing why. The story being sold to retail investors is that Warsh is a hawk who will hold rates higher for longer. That framing fits the Trump versus Powell soap opera the cable shows love. But Warsh's specific innovation isn't about the level of rates, it's about visibility. Kill the dot plot, and you kill the public's ability to see whether the Fed is cutting or holding in real time. Think about what that gives you politically. Trump can publicly demand cuts every week of 2026. Warsh can quietly hold rates flat. The public can't tell who's winning because the projection chart is gone. The financial press has to cover the press conferences, but with no dots to anchor, the coverage degrades to vibes. In that fog, hedge funds with bond trading desks at Goldman, JP Morgan, and Citi keep their information edge intact. Retail savers lose theirs entirely. I've watched the bond market reprice 3 dot plots in a row this year. The trades land in the first 40 seconds. The interpretation lands over the next 40 minutes on Bloomberg. If you're not at a desk staring at a terminal at 2 p.m. Eastern on the Wednesday in question, you're by definition the slow money. The dot plot's only redeeming feature was that it gave the slow money a printed cheat sheet. Without it, the slow money is just guessing. Connect this back to where it lands on you. The high-yield savings account paying you 5% right now is propped up by the reverse repo facility, which prices off the same expectations the dot plot publishes. The 30-year mortgage rate is set against the forward curve. Your auto loan rate is set against short-term funding markets, which key off the dot's median. Your credit card variable rate moves with the prime rate, which is set off the federal funds target, which the dots forecast in real time. Kill the dot plot, and every one of those numbers becomes harder to forecast, easier to mark up, and quietly more profitable for the banks pricing them against you. Picture the refi customer in October. Today, with a dot plot in hand, the customer can wait for a known open market committee date, watch the median move, and lock at the bottom of the rate move. Under Warsh, that customer has no projection to wait for. The committee meets, the press conference happens, and the customer is left guessing what the next move is based on Powell's tone, the way it used to work pre-2012. Banks price that fog into the offered rate. The customer pays the difference. Same loan, same risk, same borrower. $47,000 more over 30 years because one chart got abolished. So 19 unelected people draw a chart 4 times a year that moves trillions in your direction. A third of them were picked by the banks they're supposed to regulate, and the man who just took over the Fed wants to delete the chart entirely starting June 17th. The dot plot is one tool. The opacity reset is the bigger story. But the dot plot is only the front of house. Backstage, the Fed pays JP Morgan, Citi, and Bank of America roughly $176 billion a year to keep your savings parked at the Fed instead of lending it out. That's where the money actually goes.